The problem is the private credit boom, the unregulated credit boom, is there are a lot more reverse brands and tricolors out there than people will admit. And this is the opacity of private credit, pirate credit, really. No one really knows what it's worth. It reminds me, in a way, of how in late 2006 we were starting to see defaults, and yet the AAA tranches of CDXs just stayed at or close to 100 forever until they didn't. And how many more of these guys are out there? Because as you said, the regulators don't know.
Today's episode is brought to you by Teucrium. Learn more about how agricultural commodities can play a role in your portfolio by clicking the link in the description. Joined today by Patrick Perret-Green of PPG Macro. Patrick, welcome to Monetary Matters at last.
Great to see you again, Jack.
You write, Patrick, that there's an unpleasant smell in markets. What did you mean by that?
I mean, there's certainly a degree of froth. I mean, just look at what's happened with First Brands. It starts off, it's 6 billion or 7 billion, and now the FT today is saying it's like 12. Obviously, you had Tricolor as well. There's definitely an element of froth, which is uneasy. And then what we saw last week, being the geek I am, I look at the weekly Fed H8 report. So that comes out, that's the one that comes out on Fridays afternoon in the US, and it basically breaks down the bank's assets and liabilities. And the loans are broken down into commercial real estate and consumer and CNI and general loans and all this sorts, and residential. And what we've seen particularly over the past 2 or 3 years, is a surge in lending to non-depository institutions. That's how it's classified in the H8 report, otherwise known as non-banks. And then I'm sitting there Saturday morning going through the data, and all of a sudden there's the most enormous upward revision in the loans to non-banks. So literally it went up by just under 290 billion. And it sort of made me think, because a couple of weeks ago I wrote a piece about how CNI, commercial industrial lending, CNI lending was picking up. And that made me feel, that's a positive sign, because CNI lending, that's where SMEs are the ones who borrow from banks. And all of a sudden, that CNI lending now is, when you look at the numbers, because they revise them, when they do these revisions periodically, and we've seen it occasionally in the past, but they don't backdate them the entire history, but they backdated them to the start of this year. But all of a sudden it came out of nowhere. And so you see that actually CNI lending is basically stagnant. Consumer borrowing is stagnant. And all the increase, so the total loans of banks didn't change, the overall number, but it's all been shifted into non-banks. So non-banks have gone from being, if you go back to 2015, 2016, they were probably less than 5% of total bank loans. Now they were up to 10% when we looked at the data from the 10th, and then the data from the 17th, all they're up to 13%. And you go like, well, what caused that? Well, we know for a fact that I think probably loans have been misclassified. So lending were the loans to Tricolor being marked as CNI, whereas in fact they were really going to financial vehicles that have proved to be more non-bank. So the non-bank lending is all the stuff that goes into private equity and mortgages and the markets. But the real lending to the economy is basically flat. Other bank loans, the non-bank loans, are basically zero growth this year now. And so that's a little bit of a warning sign.
Let's start by just talking about these loans in the non-bank financial sector. So you were looking at commercial industrial loans, commercial loans, and you were seeing a pickup that looked very healthy to you.
Yeah.
But then we had a reclassification. The Federal Reserve reclassified that those loans weren't actually loans to commercial and industrial entities. They were loans to non-bank financial institutions. So basically, partitioners of credit outside of the banking system, that they raise real money, they raise equity, and then they say, we're non-levered. But then they are borrowing money from banks, so they are levered, and this has been an enormous growth.
The problem is it's so unregulated. This is the problem. It's outside the reams of regulators. So when we look at First Brand, for example, and the FT's done some good work on it, But there's all these different vehicles, Carnaby Capital, stuff like that. But those banks were probably commercial banks were probably, in my view, registering those loans as if they were lending them to proper companies, not to financing vehicles.
Right. So this is an auto supplier that just filed for bankruptcy, and they've got a lot of debt, a lot more than people thought.
Yeah. And this is the opacity of private credit, pirate credit, really. No one really knows what it's worth. Nobody, I mean, we can see the amount that's in PIK notes now. I think it's something like 11 or 12%.
Payment in kind.
It's sort of, and the euphoria that, I mean, you read the stuff in the media, and of course, it's the same people pumping the same thing up, and it does remind me of CDOs. But to take it down, the stories are that Fifth took a $200 million hit on Tricolor, and I just said to myself,
subprime auto lender that also declared bankruptcy.
Yeah, but the due diligence. I mean, this was a company that lent to undocumented people. So great, you've got real recourse there. Plus, then you have ICE and emigration, and they just leave the country. And there are obviously criminal investigations going on about whether they sort of double committed collateral, like, oh yeah, sold different lenders, you've got this car against you, and it's also lent out. We've seen the same in like copper frauds in Asia. And First Brands looks like they might have done similar stuff on their factoring or re-invoicing. But you go like, when a medium-sized bank is suddenly taking a loss on things like that, it reminds me of smaller banks taking losses on CDOs early in the process in 2007. It's going like, did they really know what they are doing? What was the standard of their due diligence? Or were they doing what everybody normally does? Oh, everybody's doing it, so there's safety in numbers, so we should be fine because JP Morgan are in it and Barclays are in it. So therefore we're fine. But the very fact that JP Morgan and Barclays are in it and have lost a significant amount of money as well just raises the question about what were they doing? Where was their due diligence? How much due diligence is there going on in private credit at the moment? And the private credit markets are now bigger than the listed high yield bond market.
Yeah, and Patrick, I did an interview with Bill Moreland about a lot of these loans and bank loans to non-bank financial institutions, and a lot of these reclassifications. A lot of people like that interview. One critique I did get is that, Jack, you and Bill can talk about this because there's data on it and it's reported to the FDIC and the Federal Reserve, and Bill tracks this. In private credit, this is happening all the time, times 10, but just no one knows other than a few, Bloomberg articles or Financial Times articles. And I literally, interviewed the General Secretary of the Financial Stability Board out of Basel, that's hosted by the Bank for International Settlements. That's supposed to be the central bank to all the central banks. And, I said, okay, where's your data on this? Where's the Fed's data on this? Where's the ECB's data on this? And, he didn't say this directly, but he basically, he said, oh, I'm reading the same articles that you are. And that's an issue. If basically the boss of the global regulator is reading Financial Times just like the rest of us, that's an issue.
I've seen this sort of behavior too many times in my career. The bankers get on board with it because they love the fees. The rating agencies get on board with it, just like in The Big Short, because they were getting paid more for rating a CDO than they were for a vanilla bond issue.
Right. Yeah. Private credit is increasingly being rated, and there is such a thing as investment grade private credit.
That's an oxymoron. I mean, the reality is, yes, we've had experts in this sort of distressed credit, private credit industry for a long period of time, but they were quite niche. It was small. And they did well, but now everybody's gone into it. Oh, it's like, we've got to, just like the investment banks did with CDOs in the mid noughties, and we've got our next door neighbour's got a Porsche, so we need to get one as well, and all that sort of stuff. Or more like, our next door neighbour's got an Edsel, and we need to get one as well. If anybody doesn't know the cultural reference, just Google it. But it's the whole idea of that people feel safety in numbers until they don't. And so while, yes, a lot of it may be very good, it's going, okay, well, if someone came along to you and said, okay, would you like to put $20,000 in a private credit ETF? Because that's literally what the likes of the Blackstones of this world are now trying to market.
Mm-hmm.
Would you put $20,000 of your kid's college fund into a private credit ETF? Put it this way, I wouldn't reply very nicely.
And also, if these things yielded 20% with the risk they had, sure. But these things yield like 2% more than high yield bonds. They used to yield
Which
4%.
are historically very, very expensive.
Yeah.
So high yield bonds, we're now down at, if you use like the Bloomberg Barclays high yield bond index, and the OAS is, I looked at it yesterday, was something like 266 basis points, which is pretty much down at the lows that we saw in 05 and 06. And in 21 when we had super easy monetary conditions. And your absolute yield now is about 6.5% or something like that. And you're going, well, really, I've got no protection here. We go back to reserves. And the interesting thing about reserves, because I think it is important, if we look at, we haven't had the Q3 nominal GDP now, but just doing a simple count, reserves are down to 3 trillion. And this has been coming down more recently, not because of tax payments or stuff like that. It does seem like, just like, as I was saying, oh, yeah, let's go and buy some private credit. No, it's not private credit. No, it's a commercial industrial loan.
Yeah,
well,
yeah.
No, it wasn't. It was actually a loan to a non-bank that you didn't really do your due diligence on. And the problem is, I'll come back to that. Could it be credit? Could it be the great credit? And this is the problem. The private credit boom, the unregulated credit boom, is there are a lot more of First Brands and Tricolors out there than people will admit. And back in 2006, when you had your first thing, it reminds me, in a way, of how we could see how in late 2006 we were starting to see defaults, and yet the banks on the AAA tranches of CDXs or the double A tranches just stayed at or close to 100 forever until they didn't. And are we going to see how many more of these guys are out there? Because, as you said, the regulators don't know.
Yes. What do you think, Patrick? Because certainly in that article, even though they said that the losses could be in the billions of dollars, if it's just the Tricolor and just First Brands, it's not that big of an issue. The real concern is that there are a lot more Tricolors and First Brands.
Yeah, well, it's also
there could be a lot more bankruptcies around the corner.
Well,
what do you think, Patrick?
It's the marginal effect on confidence, isn't it? It's the drip, drip, drip. Oh, we got a hit here, a hit there. It's a bit like, it's not like someone smacking you in the face. It's like slow water torture, that drip, 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 until eventually you go, oh, I've got to get out. And then you just go, right, I've had a great run, I'll take my profit. And then is it people, because we look at the price action, we've seen it so many times in markets, even 20% corrections are actually relatively common.
Yeah,
we've seen, even before COVID, we saw it in the end of 2018, and then the Fed eased and everything like that. But my point is that there's a smell that people are going, the confidence reminds me of 07. I remember in 2007, I was at Citibank at the time, and I was on a rates trading desk, and I was running my own cross-currency, multi-currency book. And we'd have a Friday morning breakfast. We'd have the senior traders from rates, from FX, commodities, credit, equities, repo, and we all come in. So we're sitting there in September 07. So we've already seen LIBOR start to spike. We haven't seen anything like that. We've seen LIBOR start to spike. Meanwhile, the equity guys are going, oh, it's great. M&A activity is strong. Earnings growth is strong. And we're looking at them because we work in interest rates, so we're naturally the pessimists in life. We work in an industry where a bull market for us is when everything's going to hell and yields are falling. But there are echoes. That's all I'm saying, and it's like, and ultimately, you're sort of your gut element. After a while, you got to trust your gut as well, and the regulators themselves, as you said when you were at the conference, the regulators themselves don't have a clue, and it's not only that. We know for damn sure that that the accountants of these companies don't have a clue, because most accountants who work for a standard accountancy firm, and I see it's BDO with, I think, First Brands or something like that.
Yeah.
How many of them actually really know to go looking for SPV? Or do they just take it? Oh, that's that. Oh, you've given us your invoice. You've given us your factoring numbers. Thank you very much. And they were probably, and you know what? They were probably using an AI program when they were doing the audit.
So something's rotten in the state of Denmark. What do you?
Certainly, I wouldn't say rotten, but maybe starting to be a little bit fragrant.
A little fragrant. Are you a sophisticated investor concerned about today's markets? With the ever-present potential for stock market corrections and the risk that bonds won't provide the hedge that they used to, you may want to consider adding an asset class that has historically offered stability when you need it most. The prices of agricultural commodities such as corn, wheat, soybeans, and sugar typically move to their own rhythm, driven by factors like weather and geopolitics, not the factors that move more traditional assets like stocks and bonds. Since inception in 2012, every time the S&P 500 has had a correction of 10% or more, the Teucrium Agricultural Fund Benchmark Index has outperformed. Getting exposure to agricultural commodities has always been tough for individual investors. And while it's not possible to invest directly in this index, Teucrium offers ETFs designed to give investors price exposure to these markets. If you're a professional investment advisor or a self-directed investor managing your family's wealth, click on the link below to learn more about how incorporating agriculture into your portfolio can help diversification and protection. Thanks for listening. Let's get back to today's interview.
So we go back to reserves. And the interesting thing about reserves are down to 3 trillion. So we're now roughly at about 9.7% of nominal GDP. So you've got Waller, who said in the past, when he thought it was about 10 to 11%, and he said, it could be 9. And then you've got some of them going, it could be 2.8 trillion. Well, in a $31 trillion economy, 200 billion is spare change. It's not neither here nor there. But if you look at reserves relative to the amount of debt outstanding, which nobody seems to talk about, or reserves relative to the amount of tripartite repo or primary dealer repo. So I think primary dealer repo, it's at 3 trillion and reserves are at 3 trillion. So the last time that ratio was so high was the beginning of 2019. And you'll hear a lot of talk about, yes, but we got this, the repo facility now, but it's largely untested.
True.
And look, go back to 2019. Everyone's sitting there. Everyone's going, the Fed was clueless. The Fed doesn't know what is the adequate level of liquidity. If it did, it wouldn't have screwed up so much in the past. So we are at a point now where I am watching out for, just little, the potential is, if we look at reserves relative to equity valuations or private credit, or is it, and if you actually look at the Fed's own description of reserves on its website, then is there enough? It comes back to this basic question, a bit like, and it echoes 2007. So what we saw in 2007 was because of central bank tightening and effectively, narrow money growth had virtually ceased. It was like 0% in the year. But broad money growth, M3, was up at 12.5%. So how much of this is, call it narrow money versus broader money, or reserves versus other measures? But I call it like the oil in the engine. And the problem is, if you're driving an old car and for the nicest possible way, you look at the way that most central banks operate, your 1970s car probably is more efficient than a modern day central bank in terms of its technology and understanding of things. And I just wonder if they've even got an oil light on their dashboard at times.
Yes.
So I'm watching these sorts of things.
I think, so reserves have gone down by a lot. So, and as GDP and everything else has gone up, reserves as a percentage of GDP are lower than they have been. As you know, the nature of the financial system kind of changed, and then, now we're in the U.S. in an ample reserve regime. So
they say ample. That's the point. They say ample until it isn't. So in fact, in 2019, reserves got down to about below 8%. Now, and then they suddenly had to do QE. Well, they said it wasn't QE, but they ended up buying bills and coupons.
Right, but I'm saying before the Fed did QE and had and managed interest rates by paying interest on reserves. Back in the day, the good old days, you could say, when they managed interest rates by managing the quantity of reserves, the amount of reserves in the system was tiny compared to now. It's like gone up by 100 times.
Yeah, it's a different system. It's a different system. But the other side of it is the non-bank system is so much bigger than it was.
Yes.
So US commercial banks, they have recourse to the Fed. They can go and tap liquidity. I'm a non-bank. I can't. Non-banks don't have access to Fed. They don't have access to swap lines. So they have those challenges. So if the non-bank system is so much larger than it was, where does the liquidity come for it?
It's going to be coming from the banks.
That's not how bankers work.
Yeah, I'm saying it has been coming from the banks. In a crisis, I agree. Yeah.
But even then, their loans are, they're quite large actually. But overall, I'm just saying. But what a bank does in times of stress, it cuts the credit line and it increases the charges.
No, absolutely. Okay, yeah. And I should say that the FT has got an article about First Brands, and they said the winners and the losers. So the losers is the owner. The CLOs, collateralized loan obligations, owned a lot of those loans.
The banks.
And Jefferies also owned them. Yeah, but the winner was actually the number one private credit firm by far, Apollo, who actually shorted some of the debt. So
but they only had a small amount of shorts because that stuff is really, really hard to short.
Yeah.
I mean, you've got to find someone who's going to allow you to go to sell you a put. So their profits are going to be tiny relative to the losses. And then on the other side of it as well, let's not forget what's going on with the consumer. So when we compare high yield credit versus consumer delinquencies, be it in auto loans or credit cards or student loans, and that's another thing people are forgetting as well, that when we're dealing with shutdown now, and one of the interesting ones is whether or not the federal government will actually not just furlough people, but actually use it to fire them. But we've also got other issues as of tomorrow. They're going to be able to go for recourse against your wages on your student loans, because we've had this very delayed function about student loans. So first of all, you had the moratorium, didn't have to make a payment, and then it was up until recently it was we're not going to take any action against you. But then it's all of a sudden it's going to because we put a moratorium against your credit rating as well. And the Fed itself has talked about on papers in previous months about the impact of delinquency on student loans on credit ratings.
So when is this actually going to go into effect? Because I've been hearing about this for 3 years.
1st of October, tomorrow.
Okay.
They can actually, if you're delinquent on a student loan, they can start taking stuff out of your pay.
Yeah.
And your credit rating is going to go to hell as well. So we're already in an environment. So the chunk of the population that's already suffering are going to suffer more. Their credit demand is going to suffer more. And it is conflicting because we see these strong consumer numbers, but then a lot of the stuff within the personal consumption has been on things like health and education and insurance, and it's not really been on enjoying life. So if you look at all the data, and there's a guy I know, Adam Josephson, who's got his own Substack, and he looks at a lot of this sort of stuff about how the recent results of restaurant chains and consumers. And I was looking at, we saw air travel picked up a little bit, but then today we've just had the conference board. Vacation confidence has just taken another lurch lower. Jobs plentiful have hit a new low. So at best, it says that growth is, or the GDP now numbers are a bit of a myth. And I think I saw David Rosenberg put out something yesterday. So we actually look at the real numbers outside of the AI boost that's going on, and how many people are involved in that in terms of, it's great building a factory, but that doesn't take that many people, but it's a lot
Patrick,
of money.
do you also believe kind of the numbers are the numbers? Like if the economy X you and me was in a recession, but you and I were spending $3 trillion on a giant unicorn pony, like that, you know, the number is what it is. It's a $3 trillion GDP number, $3 trillion unicorn.
Which,
You got to add that to GDP.
well, it's not all in one go. Obviously, they're saying
The stock
this is
market
over time.
the stock market would have extremely 8% of Nvidia. 8% of the S&P 500 is supplying all the parts and designing all the parts for the unicorn. So that's not a reason to be bearish in my book.
Well, I'd say there's another very nasty dragon across the Pacific Ocean that is coming on at a rate of knots, and
Which is
China. And so, and we know very clearly that they are doing their utmost. So yes, they're still behind, but they are doing their utmost to, so you can have the government investing in Intel and say we want to produce our own chips, but China is doing its utmost to push on forward with its own efforts. And it will catch up at some point, and it won't be that far away. And so all these Western unicorns are going to find they're going to have a much smaller market. Because, I mean, one of the things you've seen in Asia is that China has basically been able to dump goods on the rest of Asia. So its exports to Asia have gone up, and on Africa, and on LATAM. So the Mexicans can come out and, we're going to put a bit of tariff on steel or something like that. But basically, we want you to buy our iron ore and our soy, so we're not going to do much. Asia itself is so dependent on China, they basically just will go along with it. So it's great for the US to build all this AI computing power and all these great chips. Yeah. But ultimately, where's it all going to go?
Well, Patrick, I feel like I don't know the numbers, but a lot of cloud and AI cloud demand are in the U.S. and Europe. Look, I'm an investor in Alibaba. I've been very long Alibaba, but like its cloud business, there's a lot priced into a good things priced into about the future, but like its cloud business is not anything like Microsoft or Oracle or anything, or Google or Amazon Web Services. So I think like the countries that have good relationships with China, I don't know if they're sufficiently along in the value curve where their cloud demand is going to be super high, at least for the next few years. I feel like a lot of the countries that have high cloud demand are Western countries that probably are going to go with Microsoft or Google, which buy NVIDIA. And that, it's like, okay, Alibaba, you're 80% cheaper, but I don't know.
Ultimately, people have to pay for that.
Yeah.
So how much of people's income is going to go towards AI? Is it sustainable, or are they doing the equivalent? Or is the money going in the equivalent of building the most magnificent airport, except it's in the middle of the Mongolian desert? It's a malinvestment of capital. Is it ever going to really, the Tharg amounts that are going in, is it ever going to generate sustainable income relative to the money invested?
That's a really good question. And I totally think that's a good question. And it's very possible the answer is that it is a boondoggle. My question for you is, Patrick, how long do CapEx bubbles tend to last? As the economic historian, how long did the railroad capital expenditure boom last? How long did the telecom boom last? I say we're about 2.5 years into the AI CapEx boom. The Chinese infrastructure boom lasted, well over a decade. So how long do these things last?
The dot-com boom lasted about 4 years.
Okay, so that means we got another year and a half.
No. You can have the boom in activity.
Yeah,
that can go on for a long period of time because of this infrastructure, like with the railways. They're still building railways, but railway companies are going bust all the time. all around the world, and investors were losing their money. But of course, and similarly, you can talk about auto companies or airlines. I mean, think about Warren Buffett's line about airlines. Just I liked them, but I never want to invest in them. Is that to paraphrase him? But the question is, what if earnings disappoint? And there are other things as well. Just how much of a Fed put is there? I mean, I'm not just talking about the Fed. I'm talking about how much of a global central bank put is there, because I think most central bankers will, if they're honest, will hold their hands up and they'll admit that they kept not only monetary policy too easy for too long, but they kept the quantitative easing buying programs going on far too long. So the barrier to entry for the reintroduction of QE and super monetary stimulus is extremely high now.
Patrick, how much does that matter? Because you've got this great chart of reserves, and I hadn't seen a chart of reserves in many months, and I think the reason is there was a while where the global equity market and the S&P matched quite well with how much QE the Fed was doing. The Fed's been doing quantitative tightening. Multiple trillions of dollars of the balance sheet has been reduced during one of the greatest bull markets of both of our lifetimes.
Globally, yeah. I mean, the Bank of Japan is shrinking its balance sheet more aggressively than any other balance sheet. The ECB has taken. I was looking at a chart this morning, and roughly, I think at the peak it was something like 34 or 34 trillion. And forget about FX fluctuations, and we've taken like 8 to 10 trillion off global central banks' balance sheets, even allowing China's expansion of their own. But everybody else has shrunk significantly, and that process.
And it appears to have hurt the bond market more than the stock market.
Well, I mean, there is this other question about is that being offset by greater issuance at the front end of the curve? So you sort of keep more money type instruments rather than bond type instruments going out there. So it's tricky.
But Patrick, just to stick on the CapEx boom. I mean, how long do you think this is going to last? I'm not insisting upon you at all, Patrick, that this is we're in a permanent cycle of CapEx. AI CapEx is going to increase by $100 billion every year. But let's say that this is a bubble. I'm not saying it is, but let's say it is a bubble.
Well, no, I don't think
is it 2000 or is it 1997? Is it?
It's a sort of, where are we now? Well, the activity. This is like what I'm saying about the railroads. They're sort of building out of plants and stuff like that. Although it's very quick. I saw Musk's. There was on X yesterday. There was an image of his big data center.
Data center, yeah.
Yeah, and it doesn't take long to build one of those actually. So that means you're doing a huge amount of CapEx spending now. But the question is, yes, the money's been borrowed, the capital's there, we're going to spend it. It's been put aside, but the free cash flow of companies has been of Microsoft and Meta, etc., has collapsed. And it doesn't mean the valuations can't just take a massive, great punch in the face. So when does the AI bubble, and there's two bubbles, so there's the whole discussion about the huge amount of CapEx going into it. But then there's the other side of it is, well, what about the valuation side of things? And that's my question about it, is when, on the valuation side of things, the FT was writing today about OpenAI and how much money they generated and then what their sales had been and all this sort of stuff. But it was vastly outweighed by their employee comp and awarding of stock options and marketing. And how long is it going to be before they actually generate any income? So, and eventually investors want to get paid for they want a return on their money. Now it's all very well and good saying I've got in early and my stock price has gone up and I can realize my valuation, but am I actually ever going to get paid an income from it? Am I going to get a dividend? I mean, is this going to keep on going and going and going? Does NVIDIA become as valuable as 100% of global GDP? You've got to have practical reality behind everything. But I mean, my job, my clients are basically global macro guys. It's foreign exchange and interest rates, and it's been quite a fun time this year. We've had lots of good opportunities. Problem is now it's sort of sitting there. We've basically got 10 weeks left of the trading year, if that. And it does affect people's behavior. And a lot of people, when I was out and about traveling past couple of weeks, talking to clients, a lot of people are scratching their heads here. Generally, if they were constructive on bond markets, they're generally thinking that we've had a nice time, fairly neutral now. Foreign exchange, people are keeping their powder dry. But the bigger picture thing is, the big debate is, are we going to have another round of growth? Well, struggle with that, given a whole load of different concerns in various different countries. Or are we going to get muddled through? And is it? So I'm not in the inflation is a real challenge, because a lot of the elements that drove inflation we had before, such as fiscal and monetary, aren't really there. Global money supply as a whole is relatively weak. In the Eurozone, it's turned surprisingly, actually starting to fall not on a year-on-year basis, but over the past 3 months. China, everyone talks about stimulus, but if you go and talk to people like China Beige Book, I always use, when I write about China, I always use inverted commas, stimulus. So we're raising all this money, but what's it going to? Well, a lot of it's been going to these local governments to pay off debts that have been off balance sheet to basically trade suppliers. So for example, with Evergrande, they had $300 billion of debt. Okay, that's a company. Only 90 billion of it was bank and bond debt. The rest of it's trade suppliers. So if debts get paid off, it's not stimulatory. We're still seeing the housing market, the residential property market in China, continue to fall in price. That's the greatest store in wealth.
Patrick, what about the boom in exports? And I'll be honest, I'm impressed that the Chinese economy has muddled through and done so well, or done so not bad, given the huge, basically, real estate apocalypse it's had since 2021. Like, I think in terms of the amount of leverage, definitely, and in a gross volume, like, it was worse than the US 2008. And obviously we had a multi-year nasty recession, the global financial crisis. And the Chinese economy is, given that huge overhang, which I'm not saying is over, it's been pretty good with growth that
you were never allowed to have that much leverage in housing. Don't forget, so that was one of the things. You couldn't get a 90% mortgage, you couldn't get an 8% mortgage
for the consumer balance sheet, but the leverage was in the companies. Yeah.
And the consumers continue to deleverage. So, for example, consumer borrowing, household borrowing, is virtually down to zero now, year on year, whereas deposits continue to rise at about 10%. So people continue to save. They're effectively deleveraging, and they're not coming back. In terms of the exports, I think it's looking at exports have definitely saved GDP growth if you believe their numbers for GDP, because of course they don't do GDP accounting like the way we do. They don't allow for any depreciation on infrastructure investments or stuff like that. So a road is still as valuable as it was when it's built, even though or that bridge that you built is still as valuable, even though nobody's going off it and it's loss making, or that airport. So exports have been the only real source of growth for the Chinese economy, and that is clearly unsustainable now. We are in a world full of, when they're producing 30% of global manufactures and the barriers are coming up against them. And I think it's interesting. So I know we're all talking about geonomics or whatever you want to call it these days, but that is the reality of the beast. I mean, even the IMF came out. So we can criticize the tariffs, but when you read the IMF paper of a few weeks ago, that actually came out and said, well, China effectively subsidizes by at least 5% of GDP. So China effectively has its own tariffs. They're just not tariffs as we know them. And so the tariff response, and increasingly that's going to happen. And not only that, I do wonder in this geonomic sense, because we are splitting into these axes, and China is clearly, China, Russia, you can call it the Arc of Evil if you want, Iran and all these sort of connected, North Korea, or the crinks, the crink belt, whatever you want to call them. But the world is becoming more segmented, and it's very clear that the Trump administration isn't lightening up on China. The latest is coming in new tariffs on certain issues or restrictions on certain sectors, and that isn't going to go away. It's like, so you can talk about all the people, the competition within AI, because everybody's thinking that they're going to be the winner. Well, that's never the case. I mean, there's going to be some big losers.
Except for NVIDIA now. NVIDIA is the winner now.
Yeah.
But
I mean, they're basically selling the shovels to the gold miners.
Yes.
But thereafter, but even on you could argue, is that already legitimately priced?
Yeah. So Patrick, I looked up the official Chinese consumer credit number, shows exactly what you say: a growth up until 2022 and a somewhat of flatlining from 2022 to now. I will say I follow the online Chinese consumer fintechs quite closely. There has been an enormous amount of growth in that, and I don't know if that's being picked up in the data. But so Patrick, how have tariffs affected China so far? And particularly on the stock market, have you seen any impact? Because the Chinese stock market is probably the biggest major bull market we have right now, way bigger than the U.S. And how does that match what you're seeing in the data?
They're two separate things entirely. I mean, if you go back to 2015, we had China in the depths of deflation and the most excruciating, absolutely insane stock market rally. And you've got to remember that we look at the Chinese equity markets now, they're still way below their 2015 peaks. So you get this it's not only that, equity markets do not really have any effect on Chinese behavior whatsoever because so few people are involved in it. There may be a few, but it's not relative to equity ownership in the US. It's fractional. Relative to GDP, the market is a fraction of the value. It doesn't have anything like the same sort of impact. At the same time, you also get the regime coming in periodically and going, right, this is getting stupid now, calm down. So margin debt in China is now at record highs. All they'll do is they'll clamp down on margin debt. So they restrict it. So they like to have their handbrakes. Plus, what we've also seen as the equity market has taken off, particularly over the past 3 to 4 months, we've seen bond yields pick up. But the problem is when you're running an effective public sector deficit of 10 to 11% of GDP, the last thing you want is bond yields picking up.
But aren't bond yields super low? And isn't that a sign of maybe economic health? Like bond yields, right?
No, bond yields, no, they're not a sign of economic health because you've got to remember how insular the Chinese system is. Bond yields are low because effectively China has been conducting shadow QE for years now. So basically you cut what they do, especially when the demand for private sector borrowing has been so low, is been a huge amount of government bond issuance. So if you look at the total social financing this year, government state borrowing has accounted for about 60% of all that TSF, from historically being 10 to 15%. So, and what you do, or what they have done, is you reduce the reserve ratios for the banks quite significantly. You also expand repo lines, and you basically get your banks to buy your bonds.
That sounds like fiscal stimulus to me.
Well, no, because it's the money is just it is, but it isn't. It's not a fiscal stimulus. I just explained because they've got so much bad debt. It's almost like they're using this debt so with the local governments, the money that's going to the special state bonds. that is going back to repay debts, because there's also a huge amount of off-balance sheet debt that hasn't been reported, particularly amongst state and local governments, and non-government the NGFE, so the LGFEs, local governments financial vehicles. So there's hidden debt. So they're going back to pay the debt. So, but if you're someone who's owed the money in China and you're getting repaid at long last, you're not going, whoopee, I'm going to go out and buy myself a car.
Yeah.
You're just
sure, but it is patching the holes that you and China Beigebook have been pointing out for a while. Like the holes are there and they exist, but it sounds like there's some.
Yeah,
patching.
I mean, I'll take my Star Trek line. It's fiscal stimulus, but not as we know it, Jim.
Okay, that makes sense. Any views on the Chinese equity market?
Well, obviously it's the tech side of things, and banks have had a good run. And I mean, if I was completely cynical, I'd advise anybody to go back and see who was saying it was completely uninvestable at the beginning of last year. Two large US investment banks in particular, and are now going gung-ho about it. And it's got more to run. So, I mean, it's a bit like
all the time, Patrick.
I mean, we're at elevated levels here. And there are, in my markets, we're being much more nuanced. It's where is the relative value?
Yeah.
Not everybody is the same. So, for example, I've had a big call about New Zealand interest rates. Now, unfortunately, it's a tiny market, but it's been very, very, yields have fallen significantly. Other markets, yields have gone up. And I'm now at this sort of coming to this year-end piece about, well, what happens if inflation in Japan does surprise to the downside? So our long-dated JGBs are great buy, but also if that's the case and we start to see inflation undershoot to the downside in the Eurozone and in Japan, then the dollar would likely come up. And actually, if you look at, you could pretty much do a chart of, particularly since the middle of, since Liberation Day or whatever, but even since the start of the year, if you did the US yield curve, something like 2s, 30s, the dollar inverted, and the equity market, it's largely the same chart. So what happens if you end up with a flatter yield curve and a stronger dollar and wider credit spreads? Then equities will come off, and that in turn could slow consumption, and then you get into the circularity. So we're now, as I said, I'm at this phase now where we've had an active year of interest rates were way too high at the start of the year. They overshot to the downside. Then the Fed got too hawkish in the middle of the year, and we got another chance to re-engage with like 10-year yields of about 4.5%. You get down to 4%, and then you go in these waves. You can't just fixed income, and certainly if you're working in a hedge fund and you're on a rates or FX desk, you don't sit there with the same position. You're looking around. Where's my relative value? So now the conversations are, where could be the value going forward, and what do we put up on our metaphorical whiteboard to keep an eye on? Oil prices. What's happening there? China. Commodity prices are having a little boomlet at the moment, but ultimately China is still the world's largest consumer of steel and copper. It still takes 50% of the world's copper. And yet China is, funny enough, exporting copper now. Mm-hmm. Exporting huge amounts of steel. It's still exporting about 100 million tons of steel a year.
So when you look across the global yield curves, global currencies, what's the best trade or trades you're seeing right now?
I think there's probably, I look at the UK, for example, and I think ultimately we are going to see some sort of quasi fiscal tightening because the government is left with no choice. So gilts do look, within a global context, very attractive, and you get these forward implied yields that mean that, and people didn't believe me when I was telling them the other week, but effectively, you can get, because of the shape of the yield curve, so 30-year bond yields are 5.5% in the UK, which is very attractive. The
That's so
implied,
much higher than the US.
yeah. So
So that's implied that it's
you
kind of
can actually
implying a
buy.
weakening of the pound over the next 30
Well,
years.
there's not so much that, but it impacts for annuities. You can actually get an annuity now. A 65-year-old can buy an annuity that will pay them 8% per annum, if not more. Whereas in the US, it's probably closer to 6. I think I checked it out the other week. It was more like 6.25. But my point being is, Australia, the long end of the bond market, given their debt dynamics, their 30-year yields are around about 5%. They're attractive. I think JGBs are attractive. They were, again, the yield curve is very steep, but there's some changes in dynamic. You hear a lot of people talking about long end of global bond markets and changes in pensions, changes in regulation in Europe, aging populations, but that's a known in Rumsfeld terms. Then I'm always trying to find out what's the unknown.
Yeah.
Unknown could be Japan inflation actually does go down, and the Bank of Japan ends up doing very, very little. Then you'd end up with a stronger US dollar, which would certainly take, again, because a weaker dollar is another form of monetary easing.
Yes. And the dollar has been weakening.
Well, it did, but it's gone nowhere for the past 3 months, really. We've had our big fall, and then it's sort of bounced along. Asia China continues to remain soft. So therefore, then you become to a point, well, and we all know that the current account surplus is enormous, and they're shifting assets over abroad, and they're been buying gold because they've got to put the money somewhere. But what does China do? We've had 9 quarters in a row of deflation. It's the worst on record. This is becoming, yeah. Do they actually go for a sort of Japan 3 arrows approach? And that would be very good for developed market fixed income. But basically, it would be China just, how do we get around tariffs? Just devalue, because we're already eating up the margins, and we'll take the pain.
But hasn't China very slightly been strengthening the yuan?
Well, it depends on what context you look at it. It's basically been pegging it against the US dollar. If you look at the CNY on a broad effective exchange rate, no, it's actually depreciated a great deal. So, and this is another problem for for example, the Eurozone. So if you look at where Euro CNY is, that's up around about 835, 840.
The euro is strengthened against the dollar. The Chinese yuan has strengthened somewhat against the dollar, but it's weakened relative to the euro.
Yeah, and even
everything other than dollar. Yeah.
Yeah. So there is the official RMB index, and that's come off a lot. And Bloomberg do one as well. But yeah, the China has weakened the currency overall to alleviate those deflationary pressures. Now, it's clearly I think it's hitting a buffer in terms of its ability to export more. So they're not going to get the growth. So ultimately, if you want to try and get out of deflation, then you're probably going to have to do more stimulus. It could cut rates a little bit. They could just get more active in buying other assets. They could even start buying treasuries if we get past the thing, because they actually don't own enough treasuries now, you could argue.
So you like global duration, you like the UK 30-year, you like the Australian 30-year.
And Japan, and probably JGBs.
And JGBs, okay. What other trades do you like, and how do you feel about the US long end or any other trades?
Well, it's had a good run, but I think I'm looking at the pain trade perspective. Actually, the pain trade would be for the yield curve to flatten still, and the dollar to strengthen overall.
Yes, absolutely.
It's not equal.
So Patrick, what's the trade other than long duration globally? What do you like in terms of trades?
Well, I mean, I'm a sneaky buyer of the dollar. I mean, I don't. There's nothing. As I said, we're at a funny time of year now. I'm not seeing. I like my baseball, even though I'm English, and I'm going I'm batting for like, I'm trying to get my hits rather than get a homer and just load up the bases.
And you said you're sneaky buy the dollar. Why is that?
Well, as I said, I think the outlook, the deflationary impact of tariffs, China, excess production but actually, even in Japan's case, if you think about where dollar yen was at the start of the year and where it is now, and where the oil price is, and don't forget with Japan, another factor is that 98% of their energy is imported. So they're a big beneficiary of falling oil and gas prices. So that actually points to weaker Japanese inflation down the line, is that there's disinflationary risk is not priced enough into the Eurozone, nor into Japan, therefore not into their implied future interest rates. And so interest rate differentials could start to move. Whereas, of course, in the US...
So non-US interest rates are going to go down, and that's going to be bullish for the dollar.
Well, look at this. Let me put it the other way around. The other week, we had sort of 1 year, the 1 year in US dollars was at 3%, and you've got the Fed's at 4%. But in Europe, you've got 1 year close to 2%, and the ECB is at 2%. So you've got the carry argument. The carry argument works against you being short the dollar here. It's expensive being short the dollar.
Yes.
And
hasn't that been true for like 15 years against Japan and Europe?
Well, yes, but actually, if you look at long-term waves, actually, there's a high correlation between interest rates. It goes through phases.
Yeah.
But then you get that reflected in the currency. But at the moment, what we're seeing is so the risks are that actually, given how much is already priced into the yield curve, because the market is still pricing in many more interest rate cuts than in other markets, that US interest rates don't do much here, forward interest rates, and others fall. So the dollar gets an upward bid. And just another thing, it's like, record hedging of dollar investments. So that's one of the big things I recently reported, that overseas investors were buying a record amount of dollar hedged assets just at the time when the dollar's already fallen quite significantly.
Mm-hmm.
You've basically paid your hedging costs. So your optionality. So I'm just taking where's my optionality? What hurts people the most? Well, the thing that hurts people the most is actually a stronger dollar. It wipes out. It hurts on positioning,
and it hurts the administration's goals of making exports more competitive.
Yeah, but people aren't going to buy US exports. I mean, when Trump comes out with buying US exports, the US actually, he ignores all your services. So your whole trade situation is completely farcical. No one's going to buy an F-150. We couldn't fit one on a road in the UK or in anywhere in Europe as a whole, or Japan, or most of the rest of the world. Unless you're
That's true. It's true about cars, but basic economics. When the dollar weakens, it makes exports more competitive. Setting an F-150 or some product that only Americans want and other people and non-Americans don't want. And Trump is aware of that basic economics, and he's talking.
If you want to do exports, the most effective export change would be to completely screw over Ireland, who now has gone from to an enormous. Ireland is responsible for a huge amount of the EU's trade surplus with the US because of pharmaceuticals. But
correct. Most of it is phony, intellectual property agreements that.
There's huge physical exports of pharmaceuticals. They're actually manufactured in Ireland, but then they're shipped over and they're sold to. But then Pfizer Ireland or Merck Ireland will sell it to Merck US at full list price. Therefore, and they book all the profit in Ireland.
Exactly. Yeah.
So, but you can't just set up a manufacturing facility in next to no time, and changing the foreign exchange rate really won't have that much impact on US exports. But the dollar does have but it's a disproportionate relationship. Think about it. I mean, trade for the US is about 12% of GDP. Exports for Germany are 50% of GDP, or likewise for Korea or other countries. So they're much more sensitive. They actually want, ironically, they're on this one. But then you've got all the other people who borrow dollars. And this is but we're going on a lot now, but we can get into, you could do a whole session on the offshore dollar system and the offshore dollar debt and all the work the BIS has done on it. So when dollar liquidity gets worse, or shrinks, and the dollar goes stronger, that is the source of pain for people because their dollar liquidity gets worse. So how do they finance themselves? Oh, I suppose they could try going to the Chinese.
Yes. And even though the rest of the world is a net creditor to the US has a negative net international investment position. And so theoretically, a stronger dollar should, quote unquote, help the rest of the world. It doesn't act like that because the liabilities of the rest of the world are far more short-term and sensitive than the assets, which are like stocks and stuff. Patrick, what about, final question, gold?
All I would say on gold is I've got a great mate of mine who I've known for 30 years is a DeMark guru. And I've learned over the course of my career that it's never been advisable to not pay attention to his thing. And he did actually flash something up about he was getting some sell signals on gold today.
Patrick, great to see you. Thank you, everyone, for listening. Please leave a rating and review for Monetary Matters on Apple Podcasts, Spotify, or wherever else you get your podcasts. Thanks.
Cheers, Jack. Always a pleasure.
Thanks for watching. Remember to click the link in the description to learn more about the Teucrium Agricultural Fund Benchmark Index. Until next time.
Thank you. Just close the door.